only mode.
Okay, everybody. Well, thanks for tuning in. We have some pretty good information for you today. This is a topic that I deal with a lot as a financial planner, and it's certainly something that, if it's not done properly, can derail a retirement awfully quick. It's long-term care, specifically long-term care insurance. And today we're lucky to have Melissa Barnickel with us. Melissa's one of these old, she's a CPA. She used to be a CPA. She was an auditor and a controller, and I guess she must have got tired of doing boring CPA stuff because she decided to go into the long-term care field way back in 1993. So she certainly knows what she's doing with almost 20 years of experience. Right now, she's a managing partner of Baygroup Insurance. As I mentioned before, she's a CPA, but she's also certified in long-term care. So, Melissa, I'd just like to welcome you and thank you for taking time to talk with us today.
You're very welcome, Kirk. I appreciate the opportunity to chat with you about this very important issue.
Yeah, and like I said, I've seen it so often that people don't want to deal with it, just like they don't want to deal with estate planning. It kind of deals with showing that you're vulnerable, that someday you probably are going to have health issues. Um, and I also think there's a lot out there. People don't understand really what the ramifications are with long-term care cost and insurance, and they do look at the cost of insurance and just say, "Oh, this is too expensive." So I mean, it's something that needs to be clarified because, like I mentioned, it does have a big impact on somebody's plan. And
It absolutely does.
I guess I just wanted to kind of get started. One of the questions you always see is, how does somebody know if they should get long-term care insurance? I mean, how do you kind of guide people with that?
Well, you want to look at what the cost of care is today. So we'll say across the states, and I'm not sure what state all your listeners are in, but we'll say average is probably $250 to $300 a day for a nursing home. So
Okay.
if we go to assisted living, you're probably between 5,000 and 7,000 average. Some are less, some are more.
Okay.
And we're not talking the Taj Mahal in any of these pricing. And home health care is about $21 an hour. So without looking to what the cost will be in the future, because you can always add a rider that will help your benefit get to that level. So if cost of care today, and we'll just use $250 a day, so $7,500 a month, how much of that would you feel comfortable writing a check for out of your retirement income? Now, keep in mind, if you have assets that you were planning on using as your retirement, that you've done the financial planning for, that you're trying to take care of, that's throwing out a revenue. And if we say it's 3%, well, 3% return on $500,000 is going to throw off income that you're planning to live on. What if you took $7,500 a month out of that? You're not going to have much to live on,
Okay.
or your spouse isn't. So you have to think about that you're comfortable with taking out of the income of your retirement income to pay, and then the difference is what you might want to consider for long-term care insurance for the benefit level.
Okay.
And some people can self-fund, and that's always, even very wealthy people choose not to self-fund.
So a lot of it, if you're starting to look at it, are there any numbers that does somebody have to set aside 200,000 in anticipation of anytime long-term care? I mean, is there a certain number you look at,
Wow.
or is it just looking at, or do you just try to talk about the risk? Are people willing to take the risk of self-insuring, or would they rather give some of that risk to the insurance companies?
I
How do
usually
you
talk
approach
about
it?
the risk
The
and talk
risk?
about the cost. So let's say that most of my clients don't transfer the risk for a nursing home. They
Okay.
say they really want to have care at home. So where would you, Kirk, let's just use you as an example.
Okay.
If you were to need care, you need help with 2 activities of daily living. That's bathing, dressing, eating, transferring, going from your chair to your bed, toileting, utilizing a commode, and the personal hygiene, and continence, the diapers. 2 of those, expect to need care for 90 days or more, or a cognitive impairment. Okay, when that happens, where do you want to have that care? At home, assisted living, or nursing home?
Yeah, I at home if I could.
Okay, and the average cost of care is $21 an hour. Okay, so now and we'll say it's 20 because it's easier on our math, easier quick math. So we'll say $20 an hour. If you were to need care for 4 hours a day for bathing and dressing, would you want your children, who I know are young now, but when they grow up, do you want them to actually provide the care or supervise the care?
Probably supervise.
Okay, so therefore, you don't want them to be, you want them to be able to call the home health care agency to have them come in and help you. So that's going to be $20 an hour in today's cost, because remember, we're going to put an inflator on it to help you get to there. That's $80. Now, you could either say, okay, if I only need 4 hours, that's only $80. And if we take that times 30 days, then we're only up to $2,400 a month. And you say, well, out of retirement income, I might be able to handle that. But what if you need 24/7 care? And I just called this morning to find out what 24/7 care was in Harford County, Maryland, for my mother-in-law, and it's going to be $19.50 an hour. So once again, I'm going to round to $20. It's $21.50 for less than 24 hours. So if I use $20 an hour times 24, we got $480 a day. So that's more expensive than the $250 a day for a nursing home or $200 for an assisted living. So it can be very expensive. So even if you had lots and lots of money, writing a check for $500 a day is pretty hard.
Yeah.
I mean, that can impact any financial plan, whether you had $200,000, whether you had $2 million.
And I think what people don't realize is often you get the long-term care insurance not for the person who's going into the nursing home, but it's the spouse who's healthy, who they're going to depend on their retirement assets. So I mean, a lot of times that when I talk to people, you're not doing it just for the person going in. It's mostly for the survivor.
Right, because what if you said, okay, well, we're going to the cost of care, if you need a care, we just say it's almost $100,000 a year for care if you needed it in today's dollars. So what if you pulled $100,000 out of their assets, and it might not be the right time in the stock market to take them out, or if you're planning to sell the house, what if the houses aren't selling or the condos aren't selling, and you take a bath on it? Plus, and then you were also, so therefore you've liquidated the asset, but you've also liquidated the future income stream.
Yes.
That you were planning, the retirement income stream that you were planning on living on. And that can significantly impact all the future years for the survivor.
Oh, absolutely.
So I think that that's just key. And when I was asking you who did you want to take care of, it was you want the children to supervise the care. Providing the care is very hard. I have difficulty lifting my mother-in-law, who is currently almost dead weight. She's not able to do hardly anything right now, and I'm in my 50s. So when I get to be 80, I couldn't lift my husband now either, and he's not a big guy. So when I'm in my 80s or 70s, I might not be even physically able to do the care. Even if right now I say when I'm planning, I want to provide the care. So think about the capacity to be able to provide the care.
Oh, absolutely. And it's also not just the physical part of providing care for your spouse or your parent. There are tons of documented studies about the stress that the caregiver is under. So oftentimes the caregiver is the one that ends up dying first because the stress of having to take care of somebody for 24 hours a day, it gets to be too much and it really wears on them.
You are so right about that.
So
and then they come down with diseases, and then you have two people to take care of.
Oh yeah, absolutely. And there's just never a break. There's never a time for you when you have to take care of somebody for 24 hours. So
right, and when that does come to play, the family members should be part of that decision. Are we came up today? Do we bring in care from the outside that we have someone living with or a family member? Do we hire an agency or is she able to qualify to be in hospice at a facility? That's not me daughter-in-law decision.
Yeah.
That's the
Yeah.
kids. And right now, the person in care is not capable of making that decision. So maybe maybe one child doesn't want to have their loved one go into a facility. So keep in mind that they might have personal needs, or maybe you say, well, my kids are going to take care of me. Are they able to? Can one person stop working to do this?
Mm-hmm.
Do they live physically close by enough to be able to do this?
Oh, absolutely. Absolutely.
So,
And
and
then,
we've got the sandwich generation. You've got the kid, young families taking care of kids as well as parents.
yeah, there's an added stress right there. So,
Tell me about it.
one thing that a lot of people, I think, wrongly assume is that, I've got Medicare. So Medicare will take care of any long-term care issues I have. Can you kind of address, what Medicare would provide?
Okay, I think a simple way to consider what Medicare does is it's health insurance when we get to be 65 or older. There are some cases if you're younger, but for the most part, it's age 65 or older. So it's going to take care of doctors and nurses, diagnostic services. And then Part D will take care of drugs. It is taking care of skilled care, not custodial care. Remember the activities of daily living that I previously mentioned. Those are custodial care, just helping you with activities that you just need in order to live. So that is the difference. Now, Medicare will take care of hip replacements and knee replacements, and they do an excellent job of that. Typically, that is a less than 60-day situation. When you're in the hospital, you stay 3 nights, and then you go to a rehab center. If you are progressively improving for the first 20 days, Medicare pays 100%.
Mm-hmm.
If you stop improving, Medicare stops paying. The 21st through the 100th day, Medicare pays all but a certain amount, and this changes each year. 2012, it's $144.50, and it goes up $4.50 or $5 a year. So they're going to pay. So that amount would be due from you or your Medigap plan, which is the insurance that takes care of deductibles and copays that people can add on, that they can add into their insurance plan. So Medicare takes care of skilled care versus Medicaid is a means-tested program that takes care of primarily the nursing home.
Okay. And since you bring up Medicaid, when you're talking to people, at what point would you kind of just say to somebody, if you're looking at their assets, it just you're going to qualify for Medicaid? I mean, do you ever have that kind of situation pop up?
I do, and it's not a black and white decision. I think the first thing is, if people want to have home health care, Medicaid's not a solution for that.
Okay.
And most of my clients want home health care. There's a very, very long waiting list to be able to have the waiver available through Medicaid. In Maryland, it's over 14,000 people right now. So, and if you go into a nursing home first and then go home or go to assisted living, you sometimes can get up into that waiver, but there's still a waiting list to get that.
Okay.
If you're just getting on the list, definitely call and get on the list way before you need it, because it's years and years and years until you'll get there. But if somebody only has $100,000, then I wouldn't recommend long-term care insurance.
Okay. Okay.
You don't want to change your lifestyle to pay premiums.
Okay. What is sort of the ideal age, or is there one when somebody should start looking to buy a long-term care insurance policy?
I think people in their 40s should consider it.
Really?
My average age is probably low 50s.
Okay.
However, many of my clients in their early 50s start getting medical conditions that move them from a preferred health status, which could save them 10 to 15% discount, and they seem to get conditions in their 50s. Insurability is the number one deterrent. In addition, products are changing. Features are starting to be minimized as to what are being offered,
Mm-hmm.
and the pricing is going up.
Okay. So you think by buying at a younger age, before when you still get the best preferred rates, that usually pans out to be much better because the benefit. Because I mean, do you think that some of the benefits that are being offered now are going to start to go away?
Yes, they
Or
already have.
okay,
Previously, the policies offered unlimited benefit, that period, that would go on for, like if you had Alzheimer's, and if you bought an unlimited benefit period and you had Alzheimer's, it would continue to pay for, 15 years. The largest claim is like $1.7 million that has been paid out. That's a lot of money.
wow, yeah,
Um, so, so when you think about those numbers, you can understand why there have been some rate increases on some of the old products, because they didn't have actuarial evaluations. They didn't expect the policies to last as long, people to live as long, and as you live longer, there's a greater chance you'll get some type of dementia and need
okay,
care longer.
okay,
So unlimited is not even available anymore.
okay,
There are also some policies are coming out with not a strict 5% compound. They're tying it to their investment return.
mm,
I don't know about you, but I don't want my long-term care policy that's going to pay for health care to be geared toward the investment return.
oh yeah,
I'm a conservative CPA.
yeah,
I like to know
yeah.
that this is what my policy is going to grow to, and it is in a contract, and that's what my policy is going to do.
Yeah, I had
They also have some tied to consumer price index, and that's
okay,
not tied to really health.
yeah, okay, yeah. I had read one time that another factor, not only the longevity and the rise of dementia affecting what the actuaries originally projected, but insurance companies did not really expect to see interest rates drop to these levels where they're getting basically less than 2% on the bonds that they invest in. So that's also it's kind of been a double whammy for them.
Yep, and then the third item would be persistency. People do not drop long-term care insurance like they do car insurance and
Oh,
homeowners and life insurance. Once people buy long-term care, they seldom drop it.
okay,
You can always reduce benefits if premiums change and you can't manage it, or you don't want to manage the higher premium. You can always reduce your benefits. You can't increase them, but you can reduce the benefits to make it more manageable. And people are
okay,
not dropping long-term care insurance.
okay. Well,
So
what
those
what
are the
if you
three factors.
well what if you do have somebody? Let's say they're in their early 60s, mid 60s. Maybe they have a minor medical condition or something along those lines. I mean, are they at the point where it would make sense to get long-term care insurance, or should they still look to do something? And how would they keep their costs down if they're coming in with a medical condition at kind of an older age?
Well, usually people in their 60s probably they might have hypertension.
Hmm.
That's a pretty normal thing. They might have osteoporosis, and that's fine. You're just standard health. You're like most people.
Mm.
So that's not uninsurable. Even type 2 diabetes. Many people in their 50s and up are type 2 diabetic. If they're controlled with medication, and their A1, different readings, it's called an A1C rating. If that's below the level saying that it's controlled, then they are still insurable and they are standard health. So they look at now they're not looking at it just diabetic. If you've got a heart condition and you're diabetic, then we might have fewer carriers available to you. But
Okay.
you should still look at it in the 60s, definitely. I have many clients in the 60s that buy. Even in the 70s, people are still buying it. I will tell you, in
Okay.
the 70s, people are buying maybe a smaller amount.
Okay. So if you wait, then more than likely you're probably going to end up having to get smaller benefit, I would assume.
In order to keep the premium where you want it, we can right
Okay.
size it to meet
Okay.
your budget.
Okay. And can you talk a little bit, if you have a married couple? I mean, are there ways for shared benefits or anything along those lines?
Yes, there's some great benefits. First off, couples in one carrier currently, there's a 40% spousal discount. That's a phenomenal savings for you. Now, that particular carrier is changing to 20% across the country. Maryland has not yet approved it. So we're still at 40%. So that's still good. In addition, shared care that you mentioned, many of my clients select that. And what that means is each spouse, if a spouse exhausts his or her own policy, they can then go access the other spouse's policy if they still need more. So let's say you had $300,000 and you needed to use it for whatever reason, and you finished your $300,000. You could then go into your wife's policy. We'll say it was also $300,000. You have to have the same benefits for shared. So then you go in and you use $100,000 of your spouse's policy. Had you not been able to go into your spouse's policy, you would have had to deplete $100,000 of your assets, whether it's selling the house or selling stocks, hope that the market's right for whichever. You're also foregoing the future income stream you would have had on that $100,000 for that spouse. So it's significant that you can go in. In addition, one carrier, if you do shared, when one person is on claim, neither person pays a premium.
Oh, okay.
So both premiums are waived. If you had separate policies, only the person who is on claim would pay a premium. So that's another one. Another spousal benefit that most of my clients purchase is a survivorship rider. What that means is if you and your spouse, if both spouses have the survivorship rider, and you pay for your policy's in force and claim free for 10 years. Later on, you're still paying the premium. Let's say it goes out another 15 years, you're still paying it. And then one person predeceases the other. The survivor has no premium the rest of his or her life. So that's the standard one that most people get, the 10 years. There's another one for 7 years, but we won't go there. But this, in addition, if you had a shared care and you had survivorship, so let's say you got sick, you used your policy, your premiums waived, so was your wife's because you were on claim, and then you go in and use let's say you only use $100,000 in your policy, and you went on claim, and I'm sorry, you passed. The remaining $200,000 of your policy is now available to your wife. So she has $300 plus her $200, your $200. So she has $500,000 to pay for her care. In addition, because you had survivorship, she's not paying a premium for the rest of her life.
Okay.
Do you like that?
So, yeah. So there's
when one person dies, there's less money.
Yeah. So there's different riders you can put on the different policies to kind of help you, especially with spouses.
Right.
Okay. Now, the other big thing, there is a higher cost for some long-term care policies. So a lot of people want to know, are there any tax benefits or any other kind of, benefits, financial benefits for purchasing long-term care?
There are. I'm not sure what states are listing, but different states have different tax credits and tax deductions.
Okay.
In Maryland, there's up to a $500 tax credit for the first year. So if you're 41 or older, you can get $500. So if husband and wife are buying a policy and they're 41 or older, $1,000 of their first year premium, they will get back dollar for dollar from the state of Maryland. So it's a tax credit, not a deduction. Other states have different amounts. Sometimes it's 15% of the first year's premium. Some states do not have any deduction or credit. So we would need to speak specifically on those particular states. If they are self-employed, there are some age-based premium. There's a table, and it'll tell you up to, for this age, you can deduct this much of your premium. So at this point, I'm able to deduct my whole premium because I'm self-employed, and I can deduct my husband's whole premium. And that's pre-tax. Okay, so that's a good thing. In order to keep pricing down, you can work with the primary thing I think that my clients will do is they'll add a rider to waive the elimination period for home and community-based care. It adds a little bit of premium, maybe $100 a year, but it enables them that as soon as they need care at home, they can go on claim. So if we go back to when we were talking about what cost of care was, $6,000 for an assisted living, for our little example. If we needed care in the future, if 15 years down the road, it'll be $12,000, and another 15 years down the road, it's going to be about $24,000. So if we needed care for 3 months, we're now up to $72,000. You can save $72,000 if you paid $100 a year.
Okay.
Well, to me, that's worth it.
Okay.
You know, you're transferring risk. You can change. You can reduce the benefit period. From a, you know, maybe you don't do a 5-year period. Maybe you do a 4-year period or a 3-year benefit period. I would rather have a higher monthly benefit and a shorter benefit period when developing the plan. But look at the incremental cost, and we can get it down to a right thing. Benefit period is the least expensive moving part. So shared care, the sweet spot is 4 plus 4 years, 4 years for each spouse. You just have to look at incremental cost to see how to build the policy based upon the age and the health of the person.
Okay. So there's quite a little matrix you have to go through to optimize it for each client.
And maybe you don't want to do $6,000. Maybe you go down to $3,000 a month, or maybe you do $4,000 a month. You can do $100 increments. So you really can get it down to what is best for the client.
Okay. Okay, great. Well, we'll sort of end it here, but I want to open it up to questions. If anybody has any questions, there's a little tab on the GoToWebinar screen there for questions. So we do actually have one here. So this person's kind of, you know, what's a probability that you're really going to need any kind of home or nursing care? Are there any statistics on that?
Oh, there are. I'm listing them in my office. I am getting them out. Okay. Issue age. My graph starts at age 60. So can we start there?
Sure.
Okay. If you use let's see, a 90-day elimination period, there is a 35% chance that you're going to use your policy. And if you get a 90-day elimination period, there's a 35% that you will use it. Now, if we look at, but as you get older, when you're buying your policy, it gradually goes up. A percent at 65, 2% at 70, another percent at 75, and another percent at 80. So, you know, it's pretty much 35 to 38%, according to these statistics. And this was by the American Association of Long-Term Care Insurance.
Okay, so this is of people who have purchased long-term care.
Yes.
Okay. So you basically have almost a 40% chance that you're going to at some point need some nursing care. So
right.
It's a pretty high probability event, as opposed to other insurances.
It can make all your assets that you have saved so hard for, all your retirement, you know, all your 401k dwindle immediately, you know, very quickly.
You know, and a lot of people budge because the cost of long-term care is a little bit higher. But when you think about it, you know, what's the probability your house is going to burn down? So it's probably very small. I bet you it's under 1%.
It's like 1 in 1,200, I think.
Yeah. Okay. Yeah. So that's very small. So, you know, if you're looking at a 40% probability event, 35%, 40%. So obviously it's going to have to cost more to the insurance company because they have certainly a much higher probability that they're going to be paying out. And like you said, if people get it long-term care and they don't cancel it like life insurance or auto insurance or home insurance, then they're stuck paying this thing out. So it's going to be costlier.
And keep in mind that the very old policies were for nursing home only.
Okay.
And that's not where people are using, if we look at newly opened claims in 2011, 50% were for home care, 19 assisted living, and 31% were nursing home.
Okay. And you think in most of those instances it's the home care because that's what the client wants, or is it that they're not, the six tests, that they're not as needed for a nursing home?
Well, you can qualify the same way. It doesn't. You
Okay.
don't have different qualifications for home,
Okay.
assisted living, or nursing home. They are
Okay.
all the same. 2 activities of daily living, expect to need care for 90 days or more, or a cognitive impairment.
Okay. So those
So
are
they're the
people that
same qualification.
so having those policies allows those people to decide to do home health care.
They can decide what venue of care they need it. Now, I will say that single people want to have care at home, but once they need care for more than 10 hours a day,
Mm-hmm.
single people oftentimes will go to assisted living if they
Okay.
don't have a strong support staff of family
Okay.
and friends.
Okay.
But if you're married, you might stay home a lot longer because you've got one spouse to make sure you're not turning that stove on and walking away and burning down the house.
Yeah. Yeah. Okay. Well, I don't see any other questions there. Melissa, if somebody wanted to, learn a little bit more about long-term care and get to learn a little bit more about you, where would you send them?
Okay, well, they can go to our website at baygroupinsurance.com, or they can call me at 410-557-7907.
Okay. And
They
and
could
if you
also
do have,
email me if they wish.
okay. And any
And that's
listeners, anybody
Melissa at
listening,
Baygroup Insurance.
okay. And any listeners can email me too, and I can uh, pass along Melissa's information to you. So with that, I'd like to thank you, Melissa, for taking the time out to sort of enlighten us on this. I think a lot of people, when they hear this, will kind of be shocked. I think there's a big misconception about long-term care insurance and long-term care planning, and I think the more education people get, the better.
I agree. And keep in mind, you can right size the coverage to meet your budget.
Okay.
Some coverage is better than none.
Okay. Well,
Thank
great.
you.
Well, thanks a lot, Melissa.
You're welcome.
Okay, take care.
Okay, bye.